Happy Thursday, final panel of the day. Thank you very much for joining us. This is going to be a great panel. We're going to end with the best downtown and suburban developments, game-changing projects. I'm sure they have all kinds of good things to talk about. I'm going to turn it over to Andy here. Let me just get these slides out of the way.
Hello, and welcome to the final session of the day. My name is Andy Boyce, and I am the Chief Operating Officer for Dominion Realty Services and Burton Katzman Development Company. Just to give you a brief bio about myself, I started my career back in 1997 at in the tax department at Plant Moran. I am a CPA. In 2005, I went to work for another local developer, Grand Saqua, and then in 2013, I came over to Burton Katzman, and have been here ever since. I've worked on quite a bit of ground-up development, mainly in the industrial sector, and I'm also a CPA and have done hundreds of millions of dollars of financing and debt and equity raising. Today, I will be your moderator for the final hour as we discuss our final topic, which is downtown and suburban developments, game-changing projects. In this session, we'll discuss some of the major development and redevelopment projects along with the overall current landscape of development in the Metro Detroit area. With me today are a few pros, and I'd like to introduce each of them, and they will provide a brief background about themselves. And I'll start with Jared Freidman from Freidman Real Estate.
Sure. Thanks, Andy. Appreciate it. I'm Jared Freidman, Director of Opportunities at Freidman Real Estate. For those of you who don't know Freidman Real Estate, we are a full-service owner and operator model based in Michigan, but operate in 21 states across the country. We have a brokerage business, a management business, both on the commercial and multifamily side, a construction and design business, and an acquisition business. I lead our acquisition business and institutional advisory group over here at Freidman. I've been with the firm for about 4 years. Prior to that, I worked in Chicago for a couple of real estate private equity firms. And previously to that, I'm a graduate of the Indiana University. Shout out to one of my fellow esteemed panelists as well for being a fellow Hoosier. So appreciate being here with everyone and look forward to it.
Next, we have Carolina Pluszczynski from Ford Motor Company.
Hi, everyone. Carolina Pluszczynski. I'm the Development Director for Michigan Central at Ford Motor Company. Unlike my colleagues on the panel, I'm not a real estate professional. I'm actually a strategist that's working on kind of leading the effort and approaching Michigan Central in a non-traditional development way. I've been at Ford for about 20 plus years, really working in a variety of roles, transformative roles, where I've led major initiatives throughout the Ford value chain with a focus on technology.
Thank you, Carolina. And then finally, we have Jeff Schostak from Schostak Development.
Thanks, Andy. Jeff Schostak, Schostak Brothers and Company. We've been around 100 years. We are a fourth generation family owned and operated commercial industrial development company. Over the years, we've been active in all the different asset classes, retail, enclosed malls, office, industrial, healthcare, and multifamily. Recently, we've been very focused in the corporate headquarter built to suit kind of R&D flex space, as well as very active in the industrial distribution space. And just look forward to chatting with everyone on this panel.
Thank you, Jeff. As you can see, we have a great panel to drive the discussion. Similar to the other sessions, if you have any questions that you'd like to ask, you can submit them electronically, and we'll try to get anything answered that we can. With that, I've prepared some questions and topics to discuss, and let's jump in. So 2020 was poised to be a big year for development when we started. 2019 was a strong year. When the pandemic hit, everything kind of hit the pause button a little bit and delayed a lot of projects. What challenges have your companies faced in moving projects forward, development projects? And Jeff, let's start with you on that one.
Sure. Yeah, you're absolutely right. Obviously, 19 was active, and 20, had the beginnings of what was going to likely be an active development cycle, as we hoped. The biggest challenge going forward is, development is so much led by user interest, and obviously, when the pandemic hit, it was a big kind of pause button on any, big projects, large headquarter type things of that nature, those kind of like a cash hoarding, so to speak, with big users. So I think the biggest challenge going forward is when does that kind of open up again and companies realize, hey, this isn't 2008, 2009. Our balance sheets in general are in much better shape than they were then. And we have real projects and we have to do things. We need new space. And I will say it's already started to loosen up. You're starting to see it out there. The user interest, while it was very quiet on some of our larger development sites for the first couple of months of the pandemic, it has picked up. Now, I think the biggest difference is, who is active, what kind of deals are there, and, a lot of obviously heavy office requirements. That's been slower and will likely be slower until, whether it's a vaccine or whatever it is, when everyone's back in the office, companies are maybe a little hesitant right now to make large office space decisions. But on the industrial side, manufacturing, R&D, and clearly suburban multifamily, as well as even on the retail side, there are current, certain types of retail, grocery, that have done very well through this segment. So I think the biggest challenge is just the user interest and, having a huge, call it a screeching halt to what was good activity before it. And when does that kind of fully come back? And how long does it take to have the same deal velocity we had pre-pandemic?
Jared, any thoughts on that?
Yeah, I 100% echo a lot of Jeff's sentiments there. It's definitely a difficulty from a user standpoint. I think the other two big hurdles that are newer over the last couple months than previous is credit and financing, right? The pandemic really showed who had credit and who didn't have credit. And I think there's been really a bifurcation of companies, of the haves and the have-nots. So there are a lot of companies that, as real estate developers and owners, you're willing to bet on now, who have a business model that can be successful through a pandemic and grow through any type of situation, right? And there's companies that don't have great credit, right? And who you necessarily don't want to bet on, given some of the challenges ahead. So I think credit is really more of a conversation, even more than it's historically been. It's not just about balance sheet, it's about how their business can operate. And I think the second thing is the financing. I mean, the banks have been relatively quiet. They have some of their own problems on their books, loans, and some potential credit loss issues and loan losses that they need to work themselves through. So I think the big item is, banks. As real estate developers, most of us use some level of financing, depending on the leverage standpoint and situation, but you need the banks to be active. And right now, you are seeing banks active with certain asset classes, as Jeff mentioned, on the industrial side, with great credit companies and great credit tenants. But for more speculative things in nature in certain asset classes, the lenders aren't really there. So until we get a good sense of credit and the financing markets come back a little bit stronger, you're definitely going to see some challenges going forward into 2021.
Thanks, Jared. So today we're talking about game-changing projects. That's the topic of this session. And they don't get much bigger than the Michigan Central station that Ford is doing. And their plans to create a new mobility innovation district. We have Carolina here today, who is running that project, and she's going to talk a little bit about how this project will transform Ford, Detroit, and the automotive industry. And Carolina, maybe you could also give us a little bit of insight of how Ford's doing it a little bit different than a typical developer.
Yeah, sure. So maybe I'll start with kind of what it is. So Michigan Central is, as you mentioned, the new mobility innovation district that we're building in Corktown. The central station is the center point of the entire district, but it's really about building a place where we can invite entrepreneurs, developers, startup companies to all come together and really solve today's urban transportation problems. And so we're building an ecosystem, and we want to catalyze that innovation. And this project is super important for Ford because it really starts preparing the company for another century of innovation and success, as well as attracting the talent that we need to deliver on it. For Ford, for the city of Detroit and for the state, I think this project becomes really important as it continues to ensure that we are the leaders in mobility as we move forward. And so, as you mentioned, it's not about just buildings, right? We are building an ecosystem, and the transportation problems that we need to solve in this urban setting, they're tough. And so we're not doing it alone, which is why we're building this as an open platform. And we're inviting others to come in to participate in this and to really help us kind of solve those challenges. We also are, I would say what's kind of different about this is that the community is our partner. We have really strong community in Corktown, and we're building this with them. We have continued conversations with them to keep them informed of what we're doing, because we're building this innovation district in their backyard, and really trying to give them a voice as to some of the areas that they can influence, what they want to see down there, and really kind of have that open up that two-way dialogue with them.
Andy?
Yeah, I'm having a little bit of, okay, I'm back on. Okay, sorry about that. I had a little bit of technical difficulty there. My screen went blank. I apologize to everyone. Thank you, Carolina. Yeah, it looks like that project is
Central, if you want me to.
yeah, looks like the project is amazing. I know it's meant to transform that whole Corktown area, and be kind of the leader in that initiative in the innovation of mobility going forward. And so I know it's a big project that's going to do great things and absolutely game changing. Switching topics a little bit here, with the continued kind of 5% vacancy, sub 5% vacancy rate in the industrial warehouse space, along with the current changing landscape in retail and office. Lately, it appears the kind of industrial class or warehouse class has been the darling of the industry. Amazon's making significant investments. The Silverdome, recently the Fairgrounds, several other sites across the area. How are projects that Amazon's doing or taking up that much space? How are those things impacting the landscape on the industrial market and in general? Jeff?
Sure. Yeah, there's no question Amazon has been, the ultimate game changer of recent memory for, maybe any asset class, but certainly, in the distribution space. And what they've really done is they've gobbled up huge land sites across the country, but if you kind of just focus on Michigan, and some that had been sitting for some period of time, not sure what was going to happen, or some just kind of call it great pieces of real estate. And so one, they took off a lot of good quality, big land infill sites off the market. And then they also leased a ton of existing space and obviously, a lot of built to suits. And it almost seems like any spec project, you have an immediate tenant that's going to go walk through it right away with Amazon, as majority of their deals have been built to suits. But at the same token, they've leased a lot of existing space as well as some spec development. It'll be interesting to see if it has the same effect as the OEMs in this town, Ford, GM, and FCA, where when they build something new, there's a ton of supplier interest that's leasing space all over town or near the plant for that specific facility. Now you see it with Amazon. They definitely have suppliers that are out here leasing space, but we haven't yet seen it on the same scale that you see it with the automakers. So if that starts to happen, and you would think it's just going to continue to grow and grow as e-commerce continues to grow, that obviously would have a huge effect, in this town for industrial space that has historically been very auto-driven. E-commerce is now a huge chunk of that. And of course, there's other parts of the food chain that are part of the industrial space. But if Amazon can kind of release a supplier base, not even anywhere near that size of maybe the automakers, but large enough, that'll have a huge effect on more space. But having said that, even without that, vacancies at an all-time low. It seems like any building that goes up is getting leased during construction. So they've had a massive effect, and they've helped push the rents.
Jared, anything to add on that?
Yeah, no, I think that's very well summed up. And the most interesting thing to me that Amazon has had an effect, in addition to taking up all the space in the market, is the effect they've had on the financing market, right? When you look at Amazon and the space they've taken, still has a big red X over it for a lot of institutional ownership groups around the country, banks, so on and so forth. But when Amazon comes into town, they do bring national developers, which we're seeing happen right now with speculative projects over by the airport in Romulus. And you're now seeing some stuff downtown as well, too. They bring the speculative national developers, where historically the only person who built spec product in this market has been Ashley. Us from General Development have done, some build-to-suit stuff, and Jeff as well, and a handful of other developers. But you're really seeing that national interest come. But also when those buildings are sold, they're sold to major institutional private equity firms and institutional ownership groups across the country, which have really compressed cap rates. So I think Michigan, because of the Amazon effect a little bit, is now back on the map. There's a lot of institutional ownership here that's growing. And I think it's translated in some other facilities as well, too. Now you see Chrysler facilities or Ford facilities or other OEM and automotive manufacturers really selling to institutional groups. So I think it's got a great result in bringing a different base of capital here, which I think is great for real estate developers and great for landlords as well, too. They've definitely had a big effect on rents, and they're taking up a lot of space. So it's giving developers a lot more confidence to take on new sites and new build-to-suit projects. And do some other, different types of development that historically hasn't been done in this market, because now you have a different type of use coming to our market, which is logistics, which we haven't seen in a very long time.
Yeah, I mean, how much space can Amazon take? I mean, they've got the Silverdome, they've got the fairgrounds, and they had millions of square feet before that they've done over the last couple of years. I mean, pushing 10 million square feet in the market. How is there any breaking point to that, or is it just I know the pandemic has helped grow their business, obviously, and change the way we do things, but
yeah, well, in my opinion, so what you've seen that's been really interesting, right, is pre-pandemic digital online sales average about 11% of all retail sales. Throughout the pandemic, we had a large splurge, obviously, of increased digital sales, and now you're at 16% of all retail sales are online. That's a 50% growth in a matter of 6 months of digital sales. So obviously that's had a big effect on Amazon and their needs, but it's also got a big effect on a lot of the other third-party logistics providers, other companies that will be moving into the space behind Amazon. So where's the limit to Amazon? I can't answer that. I mean, I think they're going to be close to over 10 million square feet with their new fairground site, which is quite impressive. But what I'm more interested in, and what I'm more, I think is more promising, is what about the other big companies, right? Does that mean that UPS and FedEx and a lot of the third-party logistics providers are going to look to continue to grow and take on more space in our market? Do you eventually see the Walmarts of the world, the Target, the Home Depots, the Lowe's of those type of companies start building their own manufacturing warehouse and logistics facilities? Probably, because they've already started doing it in other markets. So I'm actually excited the Amazon effect has on the rest of the industry to change it and push it and continue to compete online, because I think for the warehouse and logistics business, all that's going to mean is more demand in the long term, which I think is going to be great on our industrial market.
So just kind of on that same topic. So we're seeing big malls like Summit Place, Northland being redeveloped, repurposed, and with Amazon, with how they've changed things, where do we see big box retail going? I know there's been some bankruptcies here recently. Is big box retail dead? Are malls dead, or what's the outlook on those? Start with you again on that one, Jared.
I don't think retail's dead. I don't think that's a fair statement. I think it's rapidly changing, but it needed to change, right? When you look at our average square foot of retail per person in our country, we were at pre-pandemic about 23 square foot per person on a retail basis. That's the largest of any country in the world. When you look at Canada, they're the second closest. They're at 17 square foot per person, per retail square foot. The UK and France are like 5% or 5 square feet on average. So we were oversupplied from a retail standpoint to begin with. And you had way too many shopping centers, way too many malls that didn't need to be developed in the first place, candidly. So I think we were oversupplied from a retail standpoint. So I think what you're seeing with Northland and Summit Mall, we didn't need those shopping malls to begin with, right? So those will go away. Then you couple that with the mass amounts of store closures that we've seen over the years. I mean, last year, what was interesting, we had 11,000 new store openings and 8,000 closings. You had about a net gain of 3,000. This year, though, unfortunately, you're probably going to see close to 25,000 store closings and some major retailers as well, too. Pier 1, Victoria's Secret's closing 250 stores, GameStop's closing 400. I mean, the list goes on and on. But I think it's needed because I think we were way oversupplied from a retail standpoint. So I think Going forward, you're going to see a big shift, which you already have. I think the great malls and the great retail centers will continue to be needed. Even though we do 16% of all of the retail sales online, there's still 84% that happens in some sort of brick and mortar, right? So I think that it's great that a lot of those sites are being scraped and being redeveloped, right? Because they don't need to be there to begin with. But I think going forward, there's going to be a lot of change, and you're going to have to reconfigure your retail centers for different types of users. You're going to have to reconfigure your malls. Look at what Simon Property Group is doing with their Class A malls, right? They're buying the retailers, right? They're buying JCPenney, they bought Brooks Brothers, they brought Lucky Brands, and they believe there's a future for those retailers. And they're, those business models were messed up to begin with. They're coming in, they're recapitalizing them, they're restructuring them, they're making it part of the environment that they own, which is probably a pretty brilliant strategy when you think about it, to really lower the cost structure on those. So I don't think retail's dead. I just think it's going to go through a dramatic shift, probably even faster than it has been over the last 5 years. But it was already on the track to do that pre-COVID. I think COVID just kicked it in the butt a little bit and said, time for you to catch up and really transform, because you're way behind the times. And it's going through that right now.
How about you, Jeff? Any additional thoughts on that topic?
Yeah, absolutely. I think with retail, it's really brick and mortar retail. It's all about kind of what you own today. And, I think what Jared said at the end is, a lot of retailers were struggling pre-COVID, and then COVID kind of, ended, their chances of survival for a lot of different retailers. But there's certain retailers that are doing great, and certainly in the junior box, big box space. I mean, you take TJX companies, Hobby Lobby, obviously all the grocery companies have done very well. Discounts done very well. So yes, we are way overbuilt as a nation. And I think, Jared kind of highlighted that well. I don't know how he remembers all those stats. It must be the Indiana pedigree, but but the reality is we are overbuilt, and there needed to be a disruption. And I think the right corners will be fine. I think there'll be tons of redevelopment. We're looking at some of our former Kmart sites that, might now be better served as multifamily or maybe a distribution play. So like anything else in real estate, it's, it comes down to where you're located. And if you have the right tenancy, there's certain properties today that, I think would be, that are hurting more from COVID. But certain, more neighborhood with solid anchors, whether it's grocery, drugstore, dollar type stores, some solid discounters with strong financials and business models, I think will continue to survive. But there will be a lot of disruption, because a lot of the development recently in Michigan was food related, a lot of food, and obviously food and restaurants have taken a big hit through COVID.
Right. Yeah, you mentioned the Kmart kind of repurposing those box type stores into warehouse, and we've seen that quite a bit also. There's a couple kind of big sites that have recently been taken down or be in the queue to be repurposed. Jared, your company has recently facilitated the sale of the SACD campus, a big 620,000 square foot industrial office building on 37 acres in Detroit. Jeff, your company's involved with the Palace, which is maybe a little more tech and corporate headquarters area. Are we going to see kind of more of these transactions across the region where you see these big sites being repurposed, and in particular for kind of light industrial warehouse space or corporate headquarters in the Auburn Hills area? Jeff, why don't you start with this one?
Yeah, no, absolutely. I mean, the Palace is clearly, well suited for, corporate headquarter R&D kind of tech type development. Like I said earlier, obviously large office requirements are a little slower right now. So we'll see how long that lasts. But I think as a general statement, any infill sites are going to be, you're going to have developers. And like Jared pointed out earlier, for the first time in a long time, there is, 2 or 3 large national developers, some of the largest in the country, that have come to town and bought land to develop distribution centers. So specifically distribution, which obviously could end up being some light manufacturing buildings as well. So I think the infill sites, when they come about, whether it's a former auto plant or it's a former mall, whatever it is, I think there will be a lot of interest in the short term for industrial type uses. I think heavier office will lag a little bit, but at the same time, the large infill sites, they still are going to see activity because there is still companies that have to do things. There's M&A activity that creates a real estate deal. They got another contract and they need X amount of space, or they might even be downsizing and merging, consolidating 3 or 4 different buildings. That still requires them to have a specialized building that has a large chunk of R&D and some corporate office to go with it. So while I think development might be a little slower outside of the distribution center space specifically, I think infill sites, because of where industrial, with onshoring that might happen now because of COVID, and then just distribution continuing to grow because of e-commerce and manufacturing, theoretically being closer to home, I think there's going to be a lot of interest on the infill sites to redevelop them to industrial. The challenge might be sometimes is the municipalities, and is that what they want?
Right. How about you, Jared? What are your thoughts on that?
Yeah, I think Jeff's 100% right. I think that there will be continued development, right? With that Sotheby sale, we had a ton of interested parties, both who wanted to buy it from an investor standpoint and users. We sold it in the middle of COVID for a big price, which was great execution on it. But even today, we still have a ton of interest from users on that site, even throughout COVID, right? We already executed an 80,000 square foot lease on one of the buildings. Bedrock's been super active, dealing with proposals on the other couple buildings. So there's still a ton of demand for industrial space. And I think to Jeff's point, a lot of infill sites are still going to be converted. I can speak for our company ourselves, us in general development, literally, I think on Wednesday, so yesterday, just entered into a public-private partnership with the city of Ecorse, where we will be redeveloping the old Mill Street old steel plant down there. It sits on 66 acres on Jefferson and the Southfield Freeway. We just entered that public-private partnership, and the city of Ecorse recognized that they needed warehouse logistics space in the city of Ecorse. It had a lot of great attributes to close proximity to the city of Detroit and the major freeway systems and the new bridge. And I can tell you firsthand that 5 years ago, probably no one would have looked at that, site. But I think, now with the demand from the e-commerce logistics warehousing needs, infill sites that have close proximity to major drivers will be redeveloped. So I know our company, in partnership with General Development, is doing a lot of that build-to-suit work, where we can offer up to 1 million square feet of build-to-suit on good infill sites like the Mill Street plant. So I think to Jeff's point, there will continue to be a lot of infill redevelopment for great logistics warehouse users on sites that make sense.
Yeah, and kind of adding to that, you talked a little bit about it earlier, Jared, but the spec building. So the recession hits in 2008. Spec is very challenging to do still from a financing perspective. There's only been a few players that have been able to do it. Ashley's obviously done a big chunk of it in this market. We've done a few buildings. I know you and General Development have done a few buildings. It's extremely challenging on the financing side, but as rents start to push up, the occupancy stays down. Is spec going to be able to kind of come back in focus here to kind of combat some of the high construction costs that we've been dealing with here over the last several years?
We've had a lot of conversations about speculative development, especially us in General Development. It's a scary game, right? Construction costs are getting higher. Financing, is not getting any more. Is not getting any better throughout this crisis. I mean, even though industrial is still hot demand. So I think speculative development is still a little bit of a bad word, especially in Michigan. Like Jeff said, there's 2 groups who've come into town and have done a lot of great speculative development in addition to Ashley Capital. I mean, right now in our market, believe it or not, there's over 2 million square feet of speculative development under construction, which is crazy when you think about it, because we only see 1 building at a time normally, but now you have 2 million square feet. But on a 400 million square foot industrial market, is 2 million square feet a lot of speculative construction? When Amazon especially takes a decent amount of it sometimes? Probably not, right? I think you need the national groups to come in and do that. I think that a lot of local developers, it's just a scary game to do the speculative development. So I think in our market, because of where Detroit and because of the financing markets and the way they are, you'll see some speculative development going forward. But I still think you'll only see minimal amounts, going forward in this market, unless Jeff tells me that he's going spec on the Palace or something like that. But
Well, maybe to add to that real quick is, Jared's absolutely right. The challenge with spec development is, generally speaking, the leverage is not going to be anywhere near what it's going to be on a built-to-suit, because you don't have a credit tenant, or at least a big company signing a long-term lease where you can push the leverage. So your leverage might be 50%, 60% of the cost of the deal, which obviously requires a lot of equity. And I think, to Jared's point, a lot of these out-of-state developers that have come in are playing with institutional capital and large different funds that are providing the equity specifically for this space of speccing distribution center development. And so far, it's actually been working out, and they've been leasing up. And obviously, Ashley Capital's been the most successful at it for however it's been the last 20, 30 years here, and they're still active at it. Speccing right now down the street with Dem's development, we've got a 140,000 square foot, more of a flex building, so not a distribution. So right now, the shell's about done, and so that could be 80% office, 20% R&D, or vice versa. So you get the shell up, and then you wait to see who comes, then you finish it to their specific needs. And so I think for the certain type of deals, they're there for the right site, maybe in a good park like that is in Auburn Hills and Executive Hills Park. And on the distribution side, it's generally been dominated by Ashley. And now we have these national players, with this institutional funds that make it a little easier to, kind of swallow that, large equity check that is required for speculative development. But I do think it is active in this market for the first time in a while.
Okay. Carolina, switching gears here a little bit. Another announcement came from the governor in August about the creation of the Michigan Mobility Corridor extending from Detroit to Ann Arbor. Can you tell us a little bit more about the role Ford is going to play in that development project, and also how the Michigan Central Station fits into that whole plan?
Yeah, sure. So the Michigan Mobility Corridor is kind of a one-of-its-kind effort. It's probably one of the most significant projects right now. And it really kind of brings Bill Ford's vision to life when we bought the train station in 2018. It's a 40-mile corridor that will connect downtown Detroit, Corktown to Ann Arbor, as you mentioned. And I think, Sidewalk Infrastructure Partners and Cavenue is the company. They've been awarded the project. Ford will be is one of the founding partners, and we're going to sit on the advisory board, and we're going to be working with them around the technology and the infrastructure that gets put in place. It'll be a connected autonomous corridor. And so when I think about that connection, and I think about Michigan Central being a node on that regional connection, it's exciting for us in a couple of ways. One, at Michigan Central, we're developing, as I mentioned, this testing platform where we'll develop new mobility solutions that can be scaled and tested more quickly, because now we have in Michigan Avenue, if that's the actual first route, which I'm gunning for, by the way, it can be an extension of that platform. So an idea is born out of Michigan Central, it can then quickly accelerate and be tested in a real world setting on Michigan Avenue. And that helps those solutions, those mobility solutions, scale so much quicker. The other thing that corridor provides is access. And so, Michigan Central is a 1.2 million commercial square feet district. We're bringing 5,000 employees and partners down there together. We have 11 acres of open space. And so when you think about that and keeping that, those retail shops and those foods, get that density down there, that corridor then provides that access to bring people in to the district to enjoy all of those amenities, as well as then for the residents, it gives them access out to opportunities that they may not have had before. So this project is so well timed with what we're doing at Michigan Central, and so well placed that we get to be a node on that hub.
That's great. Yeah, it sounds like a kind of a next generation thing here as we kind of move to the next great thing, but truly game changing. Switching gears a little bit here, to office. We've talked a lot about industrial. We've talked about the transportation stuff. Office, there's a lot of big projects downtown that are going up. Bedrock has the Hudson site. TCF has their new headquarters. U of M has their innovation center on the Wayne County Jail site, and there's obviously the Ford building will be some office in it also. With the pandemic and the way we're changing, doing things, and reduced people working at home more and things like that, are all these projects feasible? I mean, that's a lot of square footage. Is it feasible? Is the market deep enough? How is that product going to be absorbed down there? I know some of it's already absorbed because it's corporate headquarters. But Jared, what do you think about that one?
Yeah, well, I think you hit the nail on the head there. I mean, the nice part about all of those projects is they're build-to-suits for users, right? I mean, the University of Michigan is going to take their own space, most of the building there, right? TCF's going to do the same. You saw that with Little Caesars being built over the past couple of years. Ford obviously has a lot of their own users and their own uses that they'll be putting in that building, I assume, but I'm sure Caroline will correct if not. So when you look at that from that perspective, yes, you're adding square footage, but you're bringing new tenants downtown as well, too. And then the Hudson site, Rocket Mortgage just went public. We all know that. They're growing at a much faster pace and bigger probably than most of us really thought or realized. So they could take a lot of space in the new buildings if they needed to, too. I mean, the downtown office market pre-COVID was very well leased, especially in the Class A space. There was a lot of Class C buildings and dilapidated buildings slated for redevelopment that were not full and needed a lot of capital to go forward. I don't think those projects are going to go forward. And I don't even count those in my office statistics, right? I look at some buildings like Cadillac Tower that I just literally, or the available space at the Renaissance Center that's very difficult to lease. I don't even count that as available space in the CBD because they're not great uses. They need major redevelopment costs and users aren't going to go there anyway. But the stuff that's good, the clean stuff in Campus Martius and things that Bedrock owns is pretty well leased. So I think that the market will absorb the additional square feet because candidly, it's all user based. I think Rocket Mortgage eventually will come back downtown. I know they're remote right now, but eventually they're going to bring their workforce down there. They got a lot of investment into that city and growing at a very rapid pace. So I don't see that changing. I think a lot of the major growth of downtown is definitely going to slow. I think a lot of the speculative developments or redevelopments of some older buildings probably won't move forward. We've seen that a lot with speculative developments downtown, but I think I'm not worried so much about the office market downtown. I think though in the office market in general, I'm worried. So I'm not bullish on the office market by any means. I'm actually very bearish on the office market in general from what we're seeing across our portfolio and our kind of leading indicators. But I do think that downtown will be no worse off than the rest of the market, just given the stakeholders downtown and their long-term kind of implants down there. So.
Jeff, any additional thoughts on that topic?
Yeah, I think the biggest key will be, obviously the Hudson site is the one that is, has the most speculative space. To Jared's point, the rest were kind of built to suits. And, you would like to hope that, whatever it is, 9 months, a year from now, 6 months, whatever the time period is, that, Rocket's back in their office. Most people are back in their offices. So downtown is back opened up and lively again. And because the biggest thing we've decided the users that we have here is, attracting new users to the market to a, Class A brand new project like the Hudson site is. And obviously right now that's probably a challenging thing to do. I think in office in general, most tenants are taking a short term, are really thinking short term. If their leases are expiring, they're trying to do a short term deal and just, kick the can down the road until, things loosen up with the pandemic. So the question will be, how long does that take? And look, the Hudson project is going to take years to build. So theoretically, this happening now, and if it's hopefully behind us sooner than later, it might not drastically affect their leasing momentum. If we saw how quickly things changed with COVID over the last 6-9 months, if things change positively in that direction over the next year, theoretically Detroit could be booming again and users want to be down there again. And, the pandemic happened early on in their construction, so it didn't affect their leasing. But the biggest test will be, will they be able to attract new users that aren't in Detroit or in Michigan to, what will be a fantastic building that they're putting up.
Going to switch gears again and kind of switch to the multifamily asset class. Multifamily has been one of the hottest asset classes nationwide for the past several years. With construction costs continuing to rise, pandemic challenges now, are we in a situation where multifamily is going to see a little bit of a hiccup? You look at some of the downtown Detroit projects in particular, where a lot of projects require high rents and maybe some economic assistance to make them work with the rising development costs and cost of construction. Can these projects be successful also? Are they going to work? Jared, we'll start with you on that one.
I think the interesting thing about downtown multifamily, one, I'm worried about the multifamily sector as a whole, right? If you look at, we manage about 22,000 multifamily units. And if you look at the key indication on the multifamily stuff is collections and free rent that's needed to be offered in our portfolio. Beginning of COVID, we were at about 96% collections. And each month it's ticked down about 100 basis points. So today we're probably in the low 90s, 90, 91% in terms of collections. And the amount of free rent we've had to offer in our portfolio has gone up that we manage. Two not great statistics for brand new construction of multifamily development. Now, a lot of the collection issues are happening in the Class C and workforce housing type space that we manage, not so much affecting the Class A product, but conversely, a lot of the free rent that's being offered is on the Class A and not so much on the workforce housing product. So I think that going forward, new construction of multifamily is going to be challenging. But if you look at downtown, downtown was a funny place, right? So we had, before the rebirth of downtown, we only had 5,000 Class A and Class B multifamily units. And some guys built some really great projects downtown. And there was like 20 developments slated to happen, right? Some crazy amount of development. We were going to deliver 20,000 units of multifamily downtown. Well, a lot of that didn't happen. And now with COVID, it's not going to happen. But I do think going forward, because we didn't oversupply the market, you will continue to see the reputable developers build product downtown. Jonathan Holtzman is going to complete his City Club Apartments project, right? Some of the guys who have long track records and the right financing and the right capital base, some long-term investors will get projects done downtown. But there's probably, for every one of those projects, there's probably 5 projects that was announced that's not going to happen, right? So I think going forward, the multifamily market, a lot of multifamily markets around the rest of the country got oversupplied. Luckily in Detroit, we really didn't. What you're actually seeing though right now is a ton of suburban multifamily development that's going on. The Griffin and Royal Oak for over 200 units is going to be delivered here shortly. Brand new project out in Livonia. Jonah's going to develop another 200 units out there. That's going to be developed probably at the beginning of Q1 2021. You're seeing a lot of projects out in Troy. 2 projects right there. Edward Rose has his project. And then you also see the brand new tower going up next to 888. So you're seeing a lot of suburban multifamily development, which I think is quite interesting. And I think you'll see your fair share downtown. So I think we're going to develop a lot less than we thought, given the increasing construction cost, the decrease in free rent, and the difficulties with financing. But you're seeing multifamily development, continue to happen on a small scale with the right developers, which I think is the kind of the motto in that space.
So Carolina, I know Ford has the train station. And I know developing that whole Corktown area is kind of a big part of the plan, and certainly that will include some multifamily. Are you guys seeing a lot of interest there, or has it hit pause a little bit?
No, we actually have a couple of things underway where we know that in order to build, you got to look at the whole district, right? You have to have that density there, and so we're looking at housing as an opportunity in working with a couple of partners. But so early to tell that not much to talk about yet.
Okay, Jeff, any thoughts on the multifamily sector?
Yeah, I think they both kind of summed it up, but just to quickly maybe give our perspective is, the city of Detroit challenge with multifamily development it's expensive to do. It takes a long time. And, the rents, while good, clearly better than, most of the suburbs, they're not rents like they are in, other major cities like Chicago and San Francisco. And so what you're seeing now is a lot of concessions being offered on the existing buildings, which are going to make it challenging for people to want to build new, especially with the uncertainty of when will people be back downtown again. I mean, if, you don't have to go in the office and restaurants and bars aren't open, then it's probably not a big rush to do it. And then in the suburbs, I think it's, construction costs are still an issue. I mean, lumber has, gone way up, which is obviously a huge component to multifamily. And what we find, it really depends on where your sites are. You need to be in locations where you can push the rents. There's a lot of markets that would probably lease up multifamily well in the suburbs, but might not be able to push the rents like in Troy or Royal Oak or, certain areas of Northville or Commerce, wherever it might be, with construction costs keep rising. So I think you'll see it because suburban multifamily is probably at an all-time high at this moment in time. And I think downtown will be a little slow until things kind of open up.
Okay, thank you. So switching gears again, we're going to hit the next kind of asset class. But prior to the pandemic, downtown was kind of in dire need of additional hotel rooms. You've seen many suburban hotels. It seems like maybe the suburbs are a little oversupplied at times. I've seen a few projects that with the pandemic, they were 3/4 of the way done and they've just stopped. What's the short-term future of hotels in downtown and the suburbs? And on top of that, Carolina, do you see a component? I know of the Ford train station being. Do you see that hotel being part of that? I know I've seen some stuff on that, but we'll start with you on this one and see if you have any insight.
Sure. Yeah, we're actually looking at the top couple of floors of the train station to be a hotel or hospitality. For a couple of reasons. One, it will provide access for so many more people. I mean, when you get up there, the views are absolutely incredible. So we want to make sure that we make that available. But also, I think it helps with the whole work-live play and creating that density down there. We're going to have retail, we're going to have restaurants, and so keeping the district live during the off hours of work becomes really important in creating that density. And we think that a hotel in that area in the train station will help with that. So we're working with a couple of partners to kind of define that better and what that would look like. And hopefully we'll have an announcement soon.
Jeff or Jared, any thoughts on hotels and downtown and just how the pandemic has treated that asset class?
I mean, real quick, I guess I would say, I don't really know how deep the hotel market is or was or is going to be downtown. There was obviously a lot of boutiques coming, and the Chanel Hotel is beautiful. They did a great job there. I think with downtown is, with no events and no conferences and things of that nature, that obviously is going to really hurt the hotels short term. I do think there is a need for some larger hotels and maybe not as many boutiques that you were seeing. But again, I think kind of similar to what I said about office and multifamily in the city, I think until it really opens up, short term, you're just not seeing business travel. You're not seeing a lot of that, will hurt hotels.
Jared, any thoughts?
Yeah, I mean, same stuff. I mean, there'd be a lot of foreclosure hotel space nationally. I mean, buckle up. It's gonna get interesting.
Yeah. Yep, certainly a class that's going to get hit hard here with the pandemic. Kind of the final question I have, and really it kind of, I know in some of the earlier sessions they talked about foreclosures and what's on the docket here and what do we see in the market in general as far as maybe vulture investors coming from out of town, what you guys are seeing kind of in that light. As the pandemic hits, it seems like it maybe hasn't hit quite yet where there's that many opportunities, but what's kind of your insight on the horizon? Start with Jeff on that one.
I mean, I think one, you haven't seen a lot of those opportunities come out yet. Obviously Jared, their relationships with a lot of the special servicers, will probably have a better understanding. But I don't think you're going to see a ton of out-of-state groups coming in trying to buy the, Class B, C, or even maybe potentially some A stuff that, gets, given back to the bank and then, put out on the market. Like we talked about earlier, you don't have a lot of the national guys that have wanted to be here. They're coming here now, but they're buying, it's kind of a flight to quality. They're buying 10, 15-year Amazon leases. They're buying credit tenant leases, and that's a different story. I don't think you're going to see a lot of groups coming here trying to buy like heavily distressed assets. I think it might be mostly gobbled up by the people locally. Not to say that people won't come here, but I haven't seen it yet, enough come out there. And I also think it's not going to be like 2008, 2009, where there was in every asset class, there was just massive buying opportunities at very low per square foot pricing. So people will pop in here, no question. But I think there will be less of an appetite for the out-of-state, vulture type buyers to buy value add that takes a lot of work in Michigan compared to other markets.
And I think you nailed it on the head there again, Jeff. It's funny. Everyone's waiting for this wave of foreclosures. Oh, it's 2008, 2009 again. I'm going to go on a buying spree and buy everything for $20 a foot. You're not going to see it. You're just not going to see it. There's a couple big differences that have happened this time around versus last time around. In 2008, there was a true liquidity crisis. The Fed actually let the banks fail and then decided not to give any TARP money for 9, 10, 11 months. So you had massive, massive liquidity issues, right? This time around, the Fed and the government have done two different things, right? One, they provided TARP or whatever money you want to call it, liquidity to the system almost instantly. Within 6 weeks of a pandemic, they inserted $2 trillion of liquidity in the system. And there's another bill and package right now for another $2 trillion. I mean, the Fed's buying ETFs and bonds of companies, right? So there's massive liquidity in the system right now. The other big thing that you're seeing as well, too, is forbearance. I mean, in 2008, 2009, lenders and borrowers were not friends. They didn't like each other. There was foreclosures. People were taking back assets. Today, the banks and lenders are friends with the borrowers because this truly wasn't a borrower issue. This was truly a pandemic. So I don't really think you're going to see this big wave of foreclosures that everyone thinks you're going to see. Sure, in the hotel space and the mall space, you'll see some foreclosures. But the other asset classes, I think you'll see a ton of workout. So we're not really that, we're not going to see it. We don't think we're going to see a ton of foreclosures of assets. And the stuff that you do, we're probably sitting there saying it's probably not that interesting to buy anyway. I mean, we've talked a lot about the demand for warehouse and industrial and the great developments in that sector, right? But what we haven't talked a lot about is what the office market and the retail markets look like going forward, and the multifamily market. I mean, personally, distressed office buildings, I'm not that excited about going out and buying a bunch of office buildings, right? Or looking for a lot of those opportunities, because right now the leading indicators are telling us that space is going to get really ugly. Jeff talked a lot about it earlier. Tenants are really just thinking over the next, 12 months, 24 months in their lease decisions. I'm seeing a ton of sublease space come on the market. I mean, when you look at nationally, on average, we have about 100 million square feet of sublease space in the office market. And now you're seeing close to 150 million nationally. So you've seen a 50% increase in sublease space. So I think that, there will be some distress because of these leading indicators, but you got to be really careful of what opportunities are out there. And I think a lot of stuff is going to get worked out because when you see statistics like that nationally for office space, the banks don't want to take back a bunch of office buildings, right? They want to work with the borrowers. They were properly levered. They had the right operations. So I think you'll see them, but I think they'll be few and far between. And I think, hopefully a lot of this, issues get worked out and, a vaccine comes or whatever the indicator is. And we kind of move on to, better pastures.
Great. Thank you. So that kind of wraps up all the questions that I had for the discussion.
There's one online about construction costs.
Okay, let me find it here. Can the panel address construction costs for multi-industrial and office? Let's start with Jeff on that one.
Sure. I think construction costs are high. We all know that. I think the sectors that it affects the most are multifamily, like I kind of pointed out earlier with lumber being very, very high and not being able to push the rents as high as you can in the suburbs, and also a lack of labor, in that space. Everyone was kind of competing with the same framers or who it might be, but I don't see, that slowing down. Obviously, if less projects happen, guys are busier. They're probably be willing to lower the prices to get more work. But then I think office is the next one most hit by it. You're not going to see anyone speculating office space anytime soon, like Jared talked about. But in the built-to-suit office space, those deals do come around, and they're very, very expensive to build now. So I think it's a big challenge there. I don't necessarily know how it comes down unless it's just less and less work, but material pricing has gone up. Supply chain issues because of the pandemic have affected that some. Things are taking longer. The industrial space is the least affected, in my opinion, just because you have the most active users. So when you have enough users, they're able to push the rents, and more people are willing to pay what it costs. And a lot of times in the distribution space, they can pass that along, their rental costs along to their, whoever they're supplying for. So I think it affects that space the least because we've seen massive rent growth there, where office, you're not seeing that much. Obviously, you pay more for new construction built to suits. But I think it's going to be something that's an issue unless development really comes to a screeching halt and people want work, and pricing will naturally come down, at least on the labor side.
Do you want to add to that, Jared?
Construction costs over the last 40 years have never really come down to any large number. So, we can talk about all we want. It's just not going to happen.
Yeah.
It's just not. So.
Okay. That concludes our discussion today. I'd like to thank the Midwest Real Estate News for holding a great event, and thank all our panelists. And thank you.
Thanks, everybody. Yes, we're going to put this online on our YouTube channel where we have lots of other good stuff. We're growing our presence in video too, so keep an eye on that. YouTube, just look us up, REjournals. You'll find it. See you all. Have a wonderful day. Have a wonderful weekend. By the way, I'm in Minnesota, and we had like a foot of snow probably coming your way.